Welcome back, and we have with us Mr. Giri for a very special conversation. He's President and Head of Research at IIFL Capital to talk to us about how he's viewing markets. Great having you first off, Mr. Giri. This is Harsh here. Let me start off by setting the context. We've done very well. In fact, growth has surprised on the upside, India GDP growth. And this is despite all of the macro or the global headwinds in that sense that we are, as an economy are facing. What's leading to this outperformance, in your opinion? Is it pure consumption, and can it sustain, in your opinion?
Well, firstly, I think the GDP growth is calculated at 8.2% real and 8.7% nominal. And the gap has never been so small, and it is attributable to a very compressed deflator. And that in turn is attributable to perhaps calculation methodologies that could be debated. So I would think that the high frequency indicators are probably indicating a slightly lower number, something like 6.5 or 7 or thereabouts. And within that, we've been witnessing some acceleration, especially after the GST cuts, and especially in autos and a few other sectors. So I'm not over elated with this 8.2% real number. Let things settle down. Also, typically when commodities fall, we've seen that GDP growth, the real GDP growth looks very good. When commodities rise like they did between 2016 and 2019, the real GDP growth doesn't look all that good. That's because probably we mix up margin expansion and volume growth in the way we calculate real GDP.
Okay. What should that do to earnings? Should that trickle through to earnings as well, in your opinion, given that you're not seeing nominal GDP go up double digits? So how should earnings therefore play out? Plus, is the entire margin impact of raw material prices which have come off fully translated? Is there some scope there for improvement? What's your sense?
Yeah, I think there'll be a little bit more margin improvement that we'll see. We think metals will be strong this year, so that'll mean that margins don't run away from this level. As far as the Nifty earnings are concerned, remember that, Tamo, Indigo, some of the large banks, all of them had very poor earnings growth in FY26 based on assuming for one more quarter. And they'll all see bounce back in FY27. So we calculated that the top 10 companies in terms of earnings growth will be contributing almost 68% to the Nifty earnings growth between FY26 and 27. So there'll be Bharti, Tata Steel, a few big companies. Now, in terms of the earnings growth momentum that we've been witnessing, it's been the underlying has been, if you remove all these kinks, around 13-14% for Nifty. And that has been within this nominal GDP growth rate. So whatever the level of GDP, as long as it accelerates by 100-150 basis points, the earnings growth also should accelerate. So my expectation is that we'll have that underlying restored in FY27, plus we'll have the bounce back. So two layers to the earnings growth. So we should probably top 16-17% for Nifty comfortably this year, unless something goes wrong.
Interesting. Giri, tell me, what's a bigger concern for the market right now? Because it almost seems like we're singled out from the rest of the global market pack. Is it more to do with the deal with US, or is it really about earnings recovery? And I don't even know if it's a relevant question, but it is a question nonetheless.
The market looks at nominal GDP growth more because that's the immediate visible number that more closely correlates with earnings growth. And all said and done, the earnings growth ultimately has to come from top line growth. And top line growth has to accelerate substantially for markets to re-rate. Secondly, we've been a little bit more expensive than perhaps we deserve to be. We are at 20.4 times multiple, and we did not produce that much earnings growth. And when you look at other markets like US, for example, they not only have the top 7 companies growing at 20%, but the other 493 companies are also supposed to be growing at 7 to 8%. So they'll have a blended growth rate in dollars almost equal to the blended growth rate for us in rupees. And plus the rupee has depreciated 7% against the dollar in the last 1 year and 19% against the euro. So whichever way you look at it, we are a little bit of an expensive market. If you compare us with China, for example, their currency has done very well. They're actually up 5-6% against the rupee. The other emerging market currencies are also up. And If you look at China, if you look at we did a small analysis. We just looked at the large companies globally, all companies, and looked at the best performing companies. Most of them are US or Chinese companies, and they're all in high tech innovation sectors like drug discovery or robotics or whatever you seek out in the AI space, and not too many Indian companies in that mix. So I think as we see more innovation come through, that's when multiples go up. Is my sense of this, which is why I'm not overexcited with how cheap India is and all that. We'll probably deliver our 15-17% earnings growth, and I don't see derating. So we'll hold our own in terms of Nifty delivering about 15-17%.
Interesting. So where do you think the profit pools are going to be created next in terms of, sectors?
Well, the biggest one I think will be private banks and banks in general because there are two, three coinciding factors. Their loan growth was not very good, and during periods of low loan growth and low economy growth, you also see credit costs normally being elevated. But in this cycle, the credit cost has been low, and if growth in the economy picks up and bank lending growth also picks up, the credit costs will optically get depressed because of the denominator effect. And on top of it, we also will have the second phase of the NIM fluctuation. In the first phase, the loan yields go down, and in the second phase, the deposits also get repriced downwards. The first phase is already over for banks, and then NIM compressed. In the second phase, the NIMs will expand back to almost the old levels. So we'll have three or four factors coinciding, and we think that the growth impetus argument comes from the fact that in 2025 we saw 125 basis points of rate cuts by the Reserve Bank, and we also saw a bunch of deregulation measures in the banking space and in the general economy by the government. So both the RBI and the government and a little bit of SEBI also were very active in deregulation. All of that will make a difference to our growth rate. And from there, I think the bank lending growth will also pick up. So banks should definitely be one of the big beneficiaries. And typically when rate cut cycles happen, like we saw in 2025 and before that in 2007 to 9 and in 2002 also, uh, banks are spectacular outperformers. So we think this year also banks will do very well. NBFCs also, they're anyway growing very fast, 20 odd percent growth. Some of them like Tata Capital and the others are growing at more than 30% EPS growth rate. So the compounding is so strong and the runway is so long that we think that they'll also do well. We think that cement volumes are doing well. Uh, in hospitals, there is a good buildup of growth momentum. Then Indian pharma is doing well. So internet, I think Swiggy and Zomato will do well. So we are seeing a number of cases where the growth rate and profits will be significantly above average.
Okay, all right. Mr. Giri, thank you so much for joining us. We'd love to have extended this conversation, but we're going to have to cut it short. So thank you so much for taking our time and speaking with us.